With the help of the Tickerdata add-on in Google Sheets, I was able to build an incredibly powerful stock screener. Now, like always, you can download any of my sheets and get access to the Tickerdata add-on to automatically pull in stock financials straight into your spreadsheet at tickerdata.com at the link in the description. But when we talk about a stock screener, what exactly is the goal of a stock screener? Why do we use stock screeners? Well, essentially, a stock screener should be used to get a general idea to find out if a company is worth looking deeper into. It's simply taking a very broad overlook of the company. And so when I was building this stock screener, I had to ask myself that question. If I'm looking at a company, what are the immediate metrics I want to look at to know if the company is worth exploring more? And so you can see exactly what those metrics are here. For example, we have some free cash flow metrics. We have how much free cash flow the company generated in its most recent year, free cash flow per share in the most recent year, and then we have the free cash flow yield. Now, free cash flow yield isn't something I've talked about a lot in the past, but it's actually a pretty important metrics. And essentially what it is it's the free cash flow per share divided by the market price per share. So it's essentially how much free cash flow are you getting for the price you're paying for the company. Now, if we come over here, we can also see I have some dividend metrics listed. I have the dividend payout, I have the dividend yield, and then I have the payout ratio. Again, obviously something that I want to look at. Now, there's other dividend metrics that I love to look at, but that's a good starting place. Now, if we want to dig deeper into some of these other metrics, you can see I have 6 other metrics charted out here. We have the earnings per share, revenue per share, free cash flow per share, we have shares outstanding, debt to assets, and ROIC. Now, why are these the metrics that I chose to put on this chart when there's hundreds of other things that I would typically want to see for the company? Well, essentially, let's start with revenue per share. Revenue per share basically tells us if the company is bringing in more money every single year. Again, revenue is at the top of the income statement. So for example, in 2022, Visa was able to generate $14.06 for every share outstanding that this company has. And in 2023, we can see that grew to $15.95. So obviously we want to see growth in this over time. Now, if we come over here to the left, we have our earnings per share chart. And ideally, we'd like to see this growing over time as well. And so in the case of Visa, they've seen phenomenal earnings per share growth over the past decade, going from $1.90 to in 2023, $8.44. Now, one of my other favorite things to look at is free cash flow per share. And keep in mind, again, there's a few different things that a company can do with free cash flow, and I talk about this quite often. One, they can reinvest back into the business, they can pay out dividends, they can do share buybacks, they can attempt mergers and acquisitions, and they can also pay down debt. So for a company to be able to reward shareholders, their free cash flow per share really needs to be increasing over time. And as a dividend investor, if a company is going to be able to consistently grow dividend payments over time, we need to see growth in free cash flow per share. So obviously that's something I wanted to include in my stock screener. Now, the 3 metrics down here are a little bit different. It's not something I talk about quite as much on the channel, but they're actually extremely important. Let's start with shares outstanding. Now, most of these charts, obviously, we want to see growth in, but shares outstanding is a little bit different. We actually want to see shares outstanding declining over time. Now, why is that? Now, like I just mentioned, there was 5 different things that a company could do with free cash flow per share, and one of those things was buy back shares. Buying back shares is a phenomenal way to return value to shareholders. When a company is buying back shares, the total amount of shares outstanding will start to decrease over time. And it essentially gives shareholders more ownership of the companies that they hold. And buying back shares also makes all other per share metrics look quite a bit better. So for example, if we scroll down, let's say there's a company that generated $100 in revenue in 2022, and that company had 10 shares outstanding. Let's say in 2023, the company again generated $100 in revenue, but because they bought back 1 share, they now have 9 shares outstanding. Well, if we look at the revenue per share, all that would be is $100 divided by 10. So we could see revenue per share for that company would be $10. But if we look at this situation, again, it would be 100 divided by 9. So even though that the company generated the same amount in revenue in 2023 as in 2022, because they had less shares outstanding, they were able to generate higher revenue per share. So buying back shares can be extremely powerful. Now let's go ahead and moving forward and look at these other metrics. The other one we have is our debt to assets ratio. This is essentially our total debt to total assets. And this just tells us the total amount of debt a company has relative to its assets. So obviously we don't want to see this number go up. We want to see it stay in a healthy range, and Visa is a good example of that, with their debt to assets ranging over the past few years of around 23 to as high as around 29.75%. So Visa is such a quality company that debt to asset ratio is sitting in a very healthy range. And then finally, we have a profitability metric ROIC, which stands for return on invested capital. And essentially, ROIC is a measure of the profitability of a company's investments as a percentage of its capital from debt and equity. So essentially, this is just a measure of the profitability of the company. And what's considered a good ROC can actually vary quite a bit depending on the company and the industry they operate in, but it is generally considered you want to see an ROIC of over 10%. And again, Visa is such a quality company. We can see in 2023 they had an ROIC of 28.88%. That's pretty phenomenal. So let's go ahead and now that we've talked about these metrics, test out this stock screener. Let's say we want to look at Broadcom. Let's plug in AVGO and hit enter. And like always, thanks to the Tickerdata add-on in Google Sheets, you can see all of this data is going to automatically load in. So we immediately have insights to the free cash flow metrics, the dividend data metrics, and all these other charts that we just touched on. So I'm really excited about this stock screener. I plan on adding it to the Tickerdata library so you can download it very soon. And like always, if you'd like to be able to download any of my other spreadsheets, you can head over to tickerdata.com at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.